Hello ladies and gentlemen and welcome back to C.A.R. Entertainment. I'm your host Dylan Hamilton, and today guys we're going to be continuing with our AQ1 Business Studies Revision videos, and today we're going to be talking about our accounts and their definitions. So in your accounting part of your A level you will do your statement of financial position and your income statement, and then you also do ratios of a company that there and their present value, investment appraisal sort of stuff. But you need to know about the definitions. There's actually going to be quite a lot of definitions you need to know. These can be used in your answers. Just so you know what they mean there, if you can use them in the right context, or you may actually be asked at the very start explain what this means. So we're going to go through this and then we'll actually do a proper account about the income statement and on how they can be used later on the different video. But also excuse my horsey voice. So let's go straight into it. Well, the first definition is revenue. So revenue is income, especially of an organisation and of a substantial nature. So it's always known as sales. So it's just basically how much money the company has made. The cost of sales is the accumulated total of all costs used to create a product or service which is being sold. This does not include your distribution and administration expenses. Your gross profit is a profit a company will make after deducting the costs associated with making and selling its product before deducting tax. So it's essentially revenue take away cost of sales. Distribution and administration expenses is expenses that an organisation incurs that are not directly tied to the specific function. So it's basically like how you actually ship the product out. Operating profit is profit from business operations, known as gross operating expenses, and this operating profit is before the deduction of interest and taxes. So it's essentially also a little bit like gross profit, only it's from your business, it's for your business operation. So it can also, so if you don't see gross profit on your statement, which you will because it's one of the big ones, just use your operating profit, but they are a wee bit different. Finance expenses are the value of the expenditure which is incurred by an organisation during a reporting period, and this is due to interest. So fees and commissions will be incurred on their liabilities. Profit before tax, also known as PBT, is a measure that will look at a company's profit before a company will pay corporate income tax. Tax is a mandatory financial charge on some type or some type of levy imposed upon an organisation by the government. The profit attributable to shareholders is the net income of a company that equals all the revenues minus all of their expenses, also known as the net income non-controlling interests. It can also sort of be looked at your net profit as well. Non-current assets are a company's long-term investments for which the full value will not be realised within the accounting year. Current assets is cash and all assets that are expected to be converted to cash within a year. Current liabilities are the amounts due to be paid to creditors within 12 months. Non-current liabilities all the way around. They're long-term financial obligations that are listed on the company's balance sheet that are not due for settlement within a year. So otherwise, people that owe you money essentially, because current liabilities is what you do owe other people. So share capital are part of a company as part of capital of a company that comes from the issue of shares. Pretty obvious, only the old PLCs and LTDs, although they're the real companies that will need to massively declare their income statement and financial position. Shareholders and partnerships will also do them just for their own benefit. Reserves are liquid assets held by a bank, company or government in order to meet as expected future payment and or emergency needs. And then your profit and loss accounts are used to pay dividends to shareholders at the discretion of the management. So the final wee slide we're going to go through includes all of these. So debentures are a long-term security which yields a fixed rate of interest issued by a company and secured against assets. Preference shares are shares which entitle a holder for a fixed dividend and whose payment will take priority over that of an ordinary share dividend. So if I hold a preference share, that means I have to get a certain amount of money. I have to get that certain amount of money. Even if the company makes a loss, I have to get that amount of money, and I will be paid my money before the ordinary shares. So if there's not enough money for the ordinary shares, then that tough luck, I get the money regardless. But if I hold an ordinary share, then that share I am entitled to will vary in amount and may even be missed depending on the fortunes of the company. Trade payables are a form of accounts payable in which the amount due for goods or services is billed based on the supplier's terms. Drawings are taking money out for yourself as an employer manager. Every major CEO will do this. Trade receivable are the amounts billed by a business to its customers when it delivers goods or services to them in the ordinary course of business. Thanks for watching this video. I've been Dylan Hamilton from CCEA Entertainment, and I will see you next time.